MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices. To understand what a commodity option is, let's first understand what an option contract is. Well, options are rights and not obligations to buy or sell an underlying security at a strike price on a specific day, which is the day the contract expires. There are two types of options, American and European styled options based. In India, only European styled options are traded and options contracts expire on the last Thursday of every month. In options trading, the risk is limited for the buyer of the option and profit potential is unlimited because the buyer of an option can choose to exercise his rights to buy, which limits his risk of losing money. So talking about commodity options, it's important to note that unlike in equity options, their options involve right to sell or buy shares of a company at preset prices. In India, market regulators mostly exclusively allow options trading in the commodity futures market and not on the commodity spot market. There are two types of options here as well, call and put. Today, let's understand call option on trading commodities. Call options gives owners right to buy the underlying commodity futures at the strike price on the date of the expiry of the contract. The buyer of the option is set to go long on an option. If the buyer chooses to exercise his right to buy, then on the day of expiry, the option contract devolves into the futures contract. A buyer of a call option will only execute his right when there is an intrinsic value. That is, the strike price is lower than the prevailing price of the commodity futures contract. Let us understand the commodity option pricing, especially a call option, with an example. Suppose trader A is bearish on the prices of 1-month gold futures currently trading at Rs 1500 per lot, expecting the prices to fall. He enters into a 1-month gold option at a strike price of 1150 and pays a premium of Rs 50. The underwriter for the options contract, on the day of contract expiry, the prices of 1-month gold futures trade at 1350. A will go ahead and exercise his buying rights and convert the option to 1-month futures contract at the strike price, making a profit of 200 rupees. That is scenario 1. In another market scenario, if the market of 1-month gold futures is trading lower than the strike price of 1150 at say 1000 rupees, then the buyer of the option can choose not to exercise his right to buy at the strike price. The contract would then expire worthless without being exercised. The only loss for trader A in this scenario would be the premium paid. Currently, commodity options trade is available in crude, natural gas, gold, silver, copper and nickel.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Brought to you by MCX IPF.